And I think what's happening today, this flush in the equity markets now, there's more room to go to the downside. I mean, significant more room to go to the downside. I mean, just look at the pendulum of valuations. They're absurd.
This week's special with Miles Franklin Precious Metal Investments. Kilo Valcambi Silver Bars for only $2.75 over spot. 10-ounce Nadir Silver Bars for only $2.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa, the portfolio manager at Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this conversation.
Definitely. The first topic I'd like to discuss is the pullback we're seeing in parts of the stock market. We're seeing tech stocks sell off at the moment. Your perspective on this, and do you think this is the start of a new trend for the stock market?
I really think there's a rotation out of hyped, overvalued growth stocks that is underway here. By underway, meaning it's in progress. It's already happening. It's been happening for some time now, and it started really with software stocks basically hitting in a lot of the companies that are actually not profitable and in the realm of the market nowadays. They have been underperforming the overall equity market in general. And so we've had in different ways of measuring that. You can look at ARK Investments down over 40% since its peak in February. You can look at biotechnology companies doing the same. You can look at software stocks that have been trading at 50, 60 times sales, now being re-rated at 30 times sales, which still is ridiculous. Ridiculous valuation relative to the fundamentals of those businesses. And clearly, this is a macro regime change of inflation that is really forcing capital allocators out of those long duration assets into things like natural resources. So we've had, for instance, in 2021, the best year for energy stocks or oil and gas E&Ps in 30 years. So there is a rotation happening out of those hyped overvalued names into value stocks in general. Pure value stocks have been doing very well. Most of them fall into the tangible asset side. The companies that produce tangible assets, they're now being used as base necessities for the economy here. And so I've been very bullish on that part of the market, but also very negative in the other part. And I think it's incredible how to see the overall indices in equity markets today are still near the top. And when you look at that, it's being masked by most of the large cap growth names in general. And so I think there is a still, massive pullback or re-rating of those large cap names in the overall equity market, much lower prices to meet where valuations are and cost of capital and inflation that is impacting all those shifts. And so I'm concerned about the overall equity market. I've been concerned for some time now, and we've been focusing in those parts of those industries that have been having issues in the past now 12 months or so. But I think we'll actually be spreading to other parts of the overall equity market very soon. And I'm concerned. You're seeing GameStop and you're seeing AMC. I mentioned ARK as another example. Crypto is a great example of a part of the market that is an extension of the technology sector. Even Chinese stocks is another part that have been doing very poorly all the way back to February. Some of those companies down over 40 and 50% depending on the stock in China. So quite a lot of movements happening, quite a lot of things under the surface that are happening, and the breadth of the market is looking very weak relative to where the leadership still is as far as the large cap growth names that are, in my opinion, ripe to be re-rated at much lower price levels.
Can you kind of expand on some of the catalysts you see that may push the general stock market lower?
Well, there's a lot of, we look at the tail risks that are likely to occur here, and very I think I was looking at a poll from Bloomberg where they put out, the top two or so were, if I remember correctly, inflation was one of them, and the other one was the coronavirus. And I think the risks is here, even though it's related to inflation, and I believe strongly inflation is here to stay. Specifically, I think oil prices is a big risk for the market right now. Oil prices are at levels that are starting to cause issues, and I think there is a chance that what's happening is this gross long-term miscalculations of large government institutions away from the production and development of oil-related projects, and the push against those companies, energy companies, to be able to operate in places like Australia, pushing the country to be mostly reliant on oil imports. And a lot of countries are doing the same. Even Canada, Japan, Europe is probably the leading part of the world that is pushing for that. The U.S. is doing that as well. So we're all being reliant on a part of the global economy, which is called the Middle East, that is very, it shouldn't be reliant on that. As we know, it's a very messy part of the world. And so oil is becoming more and more a strategic macro asset in the global economy as we move along in the following years. So that's one risk, is the rise of oil prices. The second one, I think, has to do with food prices. I think food prices have a risk to start getting out of control, given the underinvestments in several parts of the economy related to food, especially agricultural commodities in general. And so we may see also a re-rate, but to much higher price levels than where they are currently. And so I think that could push and reinforce the inflationary story one more time. And so I'm a little concerned about those parts. And interest rates, most people are seeing this from the side of inflation not being so transitory, perhaps more consistent, right? And that may create issues with interest rates. But what I think the biggest issue with interest rates has to do with the flood of issuances we're seeing in the long duration side of the Treasury curve. So bonds and notes are being issued at levels like $600 billion every 3 months, with very low amount of buyers coming in, especially the 50 or 40% of the buyer of those issuances had been the Federal Reserve, and now saying to the market that they will be exiting being the buyer of last resort. Not only that, but even discussing selling those assets in the future, which seems absurd given the fact that risks a very large increase in interest rates here in the long end. So all those are risks to the market, because the market really relies on one thing: excessive liquidity and low cost of capital with low interest rates. And I'm not sure that's going to be following, in the next few months here, given the fact that inflation is a lot more consistent than central banks and policymakers perceived initially, especially a year ago.
You've mentioned how the pandemic may become more endemic, and it won't be the big scare it was in the last year and a half or so. If we do see that, how is that going to impact things financially if it's not, on the forefront of everyone's mind?
Well, it's almost like a true reopening. The thing is, it's not a reopening like we saw back in 2021, because back then people had money in their pockets, and not so much today. Saving rates have declined significantly from where they were a year ago. So we're seeing some parts of that will actually develop a little bit differently. But I do think that the issue with what you're saying is that there are industries in the markets today that have been appreciating, given the circumstances of being in a pandemic. And most of those are certainly in the software space, even in the crypto space, but mostly really in the technology sector as a whole. And so I think that those will be the most challenging parts of the market for the next years or so. And those are supposedly long duration assets. Those are companies that are promising very large amounts of free cash flow in the following years. And some of them are profitable today, but not when you look at relative to where they're being valued in the market, the multiples are basically pricing in that profitability. But the issue being they're promising much larger profitability profile in the following years. And so they're perceived as long duration assets. And so, it's important to understand the long trends of capital dynamic globally and the global liquidity that has been mostly going into technology sector. You can see that very clearly by looking at the capex trends of technology companies relative to commodity producers. There's a major divergence between the two today. And so, meaning commodity producers have been not spending enough money or spending enough capex in the last years or so, while technology companies have been doing quite the opposite. And so those are all reasons of why we may see a major rotation and refocus out of those technology parts of the economy into things that are part of the base necessities of the economy, such as natural resources and commodity-related businesses. And so, I'm very concerned about the issue with the pandemic ending, perhaps, and creating or making it even more challenging for industries that have been, really benefiting from that environment that we saw in the last 2 years or so. And, we're seeing that rotation happening already. And I think what's happening today, this flush in the equity markets now, there's more room to go to the downside. Significant more room to go to the downside. Just look at the pendulum of valuations are absurd. And so there's certainly risk for valuations to be, go back to more of a median historical levels that we've seen. And that means, a significant decline from current prices, no doubt.
If we do see the pandemic fading away into more of an endemic issue, then where do you see gold and silver heading?
Well, I think gold and silver have been certainly lagging the commodity space as a whole. And I think it's about time for them to be performing relative to commodity space, but also relative to growth stocks. We've had gold and silver miners today relative to growth stocks at very distorted levels on both sides, because growth have been extremely overvalued, but also because miners have been extremely undervalued. So that has been, that ratio has been a good barometer for risk in the past. And the other parts of the market that we've seen this happen certainly follow to a decline in the overall equity market, but an appreciation of gold and silver miners. This was in the tech bubble where we did see a little bit of an issue with gold and silver stocks, but then immediately follow back with a strong returns in that space. But also we saw this even in 2015 and at the end of 2018 as well, where the markets fell apart back in the last quarter of 2018. So I think we're kind of getting into that setup. 2021 was a whole repricing of massive monetary loosening to potential risk of tightening. And now this is mostly priced in the precious metal space. And I think, especially when you look at even the change, the rate of change of interest rates in the Fed funds rate, especially, you can see clearly that that may coincide a lot with the beginning of a move in gold prices to the upside. Why that? Well, first of all, the prior decline has to do with how gold usually is always thinking ahead of time. And, we know that the Federal Reserve is trapped at the end of the day, and there's not much of a room for raising interest rates to levels that can really fight inflation. You don't raise interest rates to 2% to fight inflation. You raise interest rates to double digits. But the Federal Reserve is not allowed to do that, given where multiples of equity markets are and the amount of leverage in the system that we all know, especially in the government side. And so it's quite impossible to foresee a scenario where, like we saw in the 70s, where monetary policy was able to follow along with the inflation trends. This time around, it's going to be quite different because it's not going to be capable of following to the same degree of inflation rates moving to the upside. So the gold and silver market have seen probably the worst part of the cycle here have already happened, which it was mostly a consolidation period. Gold still is at 1800s, which is a very profitable level right now for the miners. Silver a little bit lower than you would expect, but the gold to silver ratio being at the levels that it is makes silver look extremely undervalued. So it's all good for precious metals. Those are all good news. And for those investors that are looking at gold being replaced by cryptocurrencies or any other issues like that, are perhaps missing the point of how massively undervalued and even historically oversold a lot of those assets look today.
What I'm hearing is the issue of inflation in your mind is not going to be resolved because the Fed is not going to be aggressive enough, and then this is going to be bullish for metals?
That's exactly right. And if you go back to, it reminds me of going back to the 1960s, late 60s especially, because in the 60s we went through an environment where inflation was running below 2% or so, very suppressed inflation rates. And what made that happen was the complacency of policymaking, where they thought that inflation was never going to come back. So they began to become more and more aggressive. Today, it sounds very similar, no? We saw since the 80s, the monetary and fiscal policies have progressively become larger. And so it's a similar in that sense. But today, I think policymakers are really clueless about how much is the impact of fiscal spending, for instance, will have on inflation in the following years. Just for the fact that we're talking about a massive infrastructure development just to fix supposedly the inflation problem. That is not, if you go back to the 70s and the 60s, late 60s, when inflation was starting to get out of control, policymakers were very well aware that fiscal spending to the levels that we're seeing today would certainly create inflation. But the problem is the fiscal agenda has never been so extended. You have the green revolution happening. You have the peak inequality where there's a major focus into bringing up the bottom 50% and bringing it down the top percentiles of the population today. And financially speaking, you have the fiscal arms race with China. It's a spending arms race where both economies have been basically fighting with strategic parts of the economy where today the fiscal agenda has been very focused on helping parts of the economy here, companies especially in the U.S., that potentially could now compete with China in a global level that is perhaps a little more fair. Things that the Chinese economy have been doing for many years, which is using subsidies to help companies to become more competitive globally. This is the same thing that is happening in the U.S. today. And on top of it, you throw the infrastructure bill that is also going to come in because there's a major push towards that. So all those four things, the peak inequality, the infrastructure developments, on top of the China situation, all of those are going to be come into place into continuing to have a very large twin deficit relative to GDP, which today we're at levels that are 3 percentage points lower than what we saw back in the very worst part of the global financial crisis. So all of that is driving the demand side. Then you have the wages and salaries part, which we haven't seen in many, many decades here. And similar to the 70s, we're seeing a wages and salaries growth spiral beginning, in our opinion. And that is also going to be adding to these inflationary forces. And on top of it, you have the fiscal and monetary disorder. That is not going to be ending anytime soon. So all of those are creating a macro regime shift towards inflation, in my opinion, that are going to be changing the market leadership and the way we think about the macro economy and how we are going to be allocating assets. In my opinion, it's a great time to be putting money into commodities, tangible assets. None of us own enough tangible assets, in my opinion. And that is really what investors should be thinking about relative to those growth stocks that are extreme multiples that I think will be suffering for the following years.
All right. Well, Tavi Costa, we really appreciate your time and all your insights today. Before we let you go, where can our viewers find you online? And are there any last thoughts you'd like to add?
Well, thanks for having me. People can find me on Twitter at Tavi Costa. They can find us in our website, crescat.net as well. Well, look, I think it's a time to be accumulating assets in deep value opportunities of the market. For every dollar coming into the global equity market, about 5 cents is going to commodity producers. Only 9% of that 5 cents is going into precious metals. If you extrapolate that even further, it's a tiny amount that is actually going to exploration and development parts of the industry. And so that is where our focus is. We think that that's where the market opportunities really lie ahead. And also most of the inefficiencies in terms of prices relative to fundamentals and value that is in the ground of a lot of those projects that we find. So that is, for me, where the biggest opportunities are for the following years. Thanks for having me, by the way.
Definitely. Thank you so much, Tavi, and God bless.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.